We are covering the tax treatment of alimony and separate maintenance payments, focusing specifically on the critical changes made by the Tax Cuts and Jobs Act. The absolute most important detail for the exam is the date, which is December 31st, 2018. Any divorce or separation agreement executed after this date follows the new rules. Under these new rules, alimony is not deductible by the person paying it, and it is not considered taxable income for the person receiving it. Think of it as a simple transfer of assets, similar to a gift, where the IRS is not involved. For agreements executed on or before December 31st, 2018, the old rules still apply. Under these rules, the payer could take an above-the-line deduction for alimony paid, which reduced their adjusted gross income. The recipient, in turn, had to report that same amount as taxable income. The exam loves to test this by giving you a scenario with a 2017 divorce and asking about the tax implications in the current year. The old rules persist for that agreement. A major exam trap involves the modification of old agreements. If a couple with a 2015 divorce agreement modifies it today, the old rules, which are deductible and taxable, continue to apply unless the modification document specifically and expressly states that the new TCJA rules will now govern the payments. For example, if Tom and Jane finalize their divorce in 2023, and the agreement requires Tom to pay Jane $2,000 a month in alimony, Tom gets no deduction and Jane reports no income. However, if Mark and Sarah finalize their divorce in 2016 and Mark pays Sarah $1,500 a month, Mark can deduct the full $18,000 paid during the year, and Sarah must include it in her gross income. The exam will also try to confuse you by mixing alimony with child support. The rule for child support is simple and has never changed. It is never deductible by the payer or taxable to the recipient. Regardless of the divorce date, be careful with family support payments that combine both. If any portion of a payment is contingent on a child's status, such as reaching a certain age, that portion is treated as child support. For instance, if a payment of $3,000 per month is set to decrease to $2,000 when the child turns 18, the IRS will classify $1,000 of that payment as non-deductible child support from the beginning. For a payment to have qualified as deductible alimony under the old rules, payments had to be in cash, made under a divorce instrument. The spouses couldn't live in the same household, and the payer's liability for payments had to cease upon the death of the recipient spouse. This last point is a common exam question. If the agreement states payments must continue to the recipient's estate after their death, none of it is considered alimony. It is a property settlement. A simple way to remember the new rule is after 18, alimony is straight. It's a straight, non-taxable transfer, not a complex tax deduction and income event. This helps you recall that for any divorce agreement dated 2019 or later, the tax implications are straightforward. There are none.